While many of us are cheering that the stock markets are breaking new high, the central banks around the world are busy with their gold purchases. And the trading volume for the yield and treasury is also on a high. And I believe that institutions are also hedging and trading in all these hedging instruments. And what we could see here is over the past years, the central bank purchases in the gold market. And especially in 2022 and 23, it was exceptionally high compared to all the previous years. And in 2023, the statistic stopped at the third quarter. It have not include the fourth quarter. My name is Con Hao. My work in this channel, as always, is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. Before we discuss about today's subject, please do take some time to read into the disclaimer. And what we're seeing here are the 2 years, 5 years, and 10 years yield futures. And we also could see that the last 2 years, especially the volume for the yield futures, have picked up tremendously. And these yield futures, from my understanding, are mainly traded by the institution, but it's also open to the retail investor as well. And why are these institutions getting into these 2 years, 5 years, and 10 years yield futures? Is because they believe that inflation is still on the rise. And that's one of the clear explanation. And what is SOFR? And we can see that the volume increased tremendously at the end of last year. It stands for Secure Overnight Financing Rate. It is like the cost of borrowing cash overnight in the US Treasury market. And we can see that the volume increased as well. Gold, yield, and the treasuries increased tremendously. And before we discuss about this yield curve, let's also find out the difference between interest rates and yields. Interest rate is determined by the central banks, whereas yields that we're seeing here are determined by the investor. Typically, interest rate and yields should move in tandem together, meaning that they will ultimately move along the same direction, one leading the other. And let's talk about inverted yield curve. But before that, let's discuss about what is a healthy yield curve. A healthy yield curve is where the longer term borrowings, like the 30 years or the 10 years, compared to maybe 5 or 2, the rates are higher than the shorter end. And but what today we're seeing are the unhealthy yield curve, or we call it the inverted yield curve, where we could see that the short term yield, the 2 years, compared to the longer end, 5, 10, and 30 years, are higher. Where we can see that this 2 years yield is at 4.627% compared to 5 years, 10 years, and 30 years, which is much lower. And this is what we call an inverted yield curve. And let me give you a practical example that if you were to lend or borrow money, say a longer tenure like the 10 or 30 years, you will expect to earn or pay more interest for this 10 or 30 years loan contract because it's into the future. But today, what we're seeing here, this relationship has inverted, which we call the inverted yield curve, where borrowers will have to pay more for their short term loan, like this 2 years yield we're seeing for compared to their longer term borrowings. Now, we're going to discuss about how the institution hedge into this inflation pressure that all around the world that we're still facing. And of course, what we're seeing here on the upper pane, these are the cash market. And for them to trade or hedge, or even retail investor to trade or hedge, you can get into all these yield futures. Now let's discuss about how this all these institution hedge into the yield futures. And this is a 2 years yield cash market. And we can see obviously that since the 80s until the recent years before the pandemic, the yield has been on this very healthy decline on the downtrend, which was good. The borrowings are making cheaper, and that's why we see the stock market is higher. But with the pandemic, suddenly everything changes. And we could see that technically I've broke above this long-term downtrend line, and the institution know that the inflation pressure is still ongoing, and to hedge into the unforeseeable futures. So one of the instrument that they'll be using is all these yield futures as a hedge. Means that they are looking at to buy into it because the yield that they suspect or they believe that it will continue to rise. And let's look at the maybe a bit smaller picture here. And how do they hedge? Since they've broken on this earlier, the monthly uh, term perspective on the longer term, now we're going to look at the short term. On every dip, on every retracement, you'll find every opportunity to see if there's a possibility to buy into the yield. And these are just one example here. Of course, they'll be looking at other techniques or methods or methodology. And I just happened to analyze that there's this very nice parallel trend line over the last 2 years. And every time when ever there's a dip like this, we saw a double bottom, and it also fall in line with this uptrend channel very nicely. And so at the point in time, they have to make the assessment if it is time to get into the yield again. And in conclusion is that when the yield curve is inverted, what does it mean? It also means that uncertainties are ahead of us, but opportunity are always out there. Perhaps we should do what the central banks and institutions are doing now. While many of us may be distracted with the AI rally, but today we're able to sniff out where the smart money are shifting their funds into and where they are getting a little bit nervous and already making plans. Next week, I will bring you to the insight of this goal and yield ratio. Stay tuned for my coming tutorial. The market are always telling us on their next move. I've included more information and trading and hedging into the 2 years yield futures. And if you're also a mid to short-term trader like myself, the live data feed helped me greatly in making timely trading decisions. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you stay through this tutorial. You have many great trading weeks ahead.